Hello everyone and welcome to this RSM online seminar. Many of you will know that we've been running these seminars focused on offshore matters for a number of years now in the Channel Islands and the Isle of Man. It's unfortunate that this year we can't run this in person, but we hope that this online version still allows us to connect with you on the technical content, and we'll have to save the networking for another year. Today's seminar will be focusing on the legal and tax issues that you might be facing in relation to your UK connected clients. We have a fantastic array of speakers, all partners of the RSM UK firm, all are focused on private client matters and all regularly advise offshore structures on tax and legal matters. I'll introduce them all to you shortly. Before I start, I just want to run through some housekeeping matters, particularly how to raise questions during the course of the seminar. On the right-hand side of your screen, you should see a Q&A section. Please do type your questions in there and the presenters will see it. Please do so as you go through the presentation. We'll take all the questions at the very end, but as a question comes to mind, please just raise it in that Q&A bar on the right-hand side. Towards the bottom of your screen, you'll see a small menu which will come up where there is also a chat function. Please don't use that for questions. If you do use it, it'll be visible to everybody. We may not see it as presenters because we'll be focusing on the Q&A section. So I would ask you to raise any questions on the right-hand side. If we can move on one slide. Secondly, before I start and introduce the speakers, no current presentation at the moment can go without mentioning the pandemic. For today, I'll only mention the economic impact, and of course the personal consequences for many around the world, which might include you and our clients, has of course been significant. On the economic side, last year, just to give some context around where we think government thinking on taxes might go, for the whole year, the UK borrowed around about 60 billion. In the first 3 months of this fiscal year, starting in April, the UK borrowed about 128 billion. And for the full fiscal year, it's expected that borrowing will reach about 350 billion for all the coronavirus schemes and to help individuals and businesses. So those are quite big numbers. If you bear in mind that income tax raises just about 200 billion in the UK, IHT and capital gains tax about 5 and 8 billion respectively. 350 billion of borrowing this year is a big number and will add to the existing total debt of a staggering 1.8 trillion. So, I'm not an economist, but hopefully it doesn't take an economist to say that future spending cuts will come and taxes will more than likely rise if we in the UK hope to have any impact on those very, very large numbers. Now, taxing non-residents has generally been less politically damaging. I think governments also realise it needs to be competitive. By the very nature, international clients have more choice of jurisdiction for residence or acquisition of assets. So on this slide that you can see in front of you, I've listed some of the taxes that are already hitting or are scheduled to hit the international market and are well known probably to you, and many of you are probably dealing with these issues already. Inheritance tax on residential properties, not just a tax on residential property itself, but on loans used by underlying companies in your structures, or loans even out to beneficiaries. Who knows what they use it for, but if they've used it for residential property, you as trustees could have an issue. Highly complex and causing us a lot of interesting problems at the moment, particularly as the 10-year charges hit from trusts that have been around for many, many years. Changes to capital gains tax in UK property has been unfolding over the years. Last change being the introduction of capital gains and corporation tax on all properties and indirect holdings. The one that's always bizarre to me, but is true, is that if you're an offshore trustee, you sell an offshore company from one offshore trust to another offshore trust. So offshore company from offshore trust to offshore trust, you can still be liable to UK CGT if somewhere underlying the structure there's a UK property. So that could cause some interesting scenarios. The changes in income tax for non-resident landlords to corporation tax will be covered later in this seminar. Protective settlements still gives some interesting headaches, particularly around things like how to add to trust property without actually making additions. For example, if you've got a dry structure and you try to refurbish a property without lending or adding, it might sound impossible, but we think we have a solution for that, which we've implemented on a few cases. What's coming up? Well, SDLT for non-residents, 2% surcharge starts next year. So I think if you are planning to make purchases or restructure any property assets, including de-enveloping, if anybody's still doing that, now is probably the time, and certainly up to March next year. And just announced last week, making tax for digital hasn't gone away. It's still going to happen, and it's unfolding slowly. 2023 for landlords with income over 10,000. So if you have entities with rental income receipts, you need to start thinking about how you'll convey that information under Making Tax Digital direct to HMRC, and what software you will need and how you'll report on that. As you would expect, RSM can help with all of those things. On my next slide, if we can just move along, I've listed some of the unknown changes, even though we had the known changes. Remember that big deficit, there will be more to come. More changes, capital taxes. There was an IHT review by the UK's Office for Tax Simplification last year, the ATS. They made a number of recommendations, but we then had an election, we then had the first stage of Brexit, and of course the pandemic hit. So it hasn't gone away, I think it's still there. The ATS has now been asked to look at capital gains tax, so we expect that both of these taxes, inheritance tax and CGT, will be looked at together. And then you could throw a wealth tax into the mix, and you will start to see a shift to how capital and capital transactions will be taxed in the future. It's going to be very interesting, I think, to see how this develops while the government tries to keep a commercial eye on international investment into the UK. Having said that, at the moment, as I said earlier, IHT and CGT only raise around about 13 billion, which is not much in the scheme of things, and even big changes won't really impact that deficit. But it will be seen politically to be hitting the wealthiest. The big hitter, though, of course, is income tax and national insurance. Even small increases in rates will have a big impact on the tax take. So watch out for trust rates increasing, dividend rates increasing, the top rate of income tax increasing. There will be a window for planning during the course of this UK financial year up to March next year, I suspect. If I'm wrong, it'll only be because they brought in changes earlier. And finally, some of you might have read already, if you're over 14 in the UK, an additional tax or national insurance payment is being rumoured in order to pay for future elderly care. These are desperate times, and I think the key message is existing taxes are likely to go up. Some new taxes may be introduced. I think we all need to be engaging in discussions with our clients now and consider their monetary needs, cash needs over the next few years, and it may well be prudent to extract value or carry out transactions sooner, probably during this financial year rather than later. So that's a bit of a bleak picture to paint. Apologies for that. Let's move on. Let me introduce our speakers. I'm Gary Haynes. I head up the private client services business for the UK firm of RSM, and I co-lead the PCS business across our European firms. Very pleased that we can be joined by Sophie St. John, who leads our UK private client legal business with a wide range of legal issues, both onshore and offshore. Rachel and Andrew are tax partners, and they are entirely focused on dealing with international private clients and their related structures. They'll do some short intros at the start of their talks. The agenda for today. Sophie will take us through the issues that could arise now for trustees as a result of the current pandemic, but which could cause problems into the future. Very interesting few points that are being raised by Sophie there. And then Rachel will take us through the changes to corporation tax for non-resident landlords. And then finally, Andrew has the great joy of going through the reporting requirements under DAC 6 for private wealth structures, which I'm sure you're all already considering. So on that note, I'm going to hand straight over to Sophie to start.
Thank you, Gary. Hello, everybody. My name is Sophie St. John. For those of you who don't know me, as Gary mentioned, I'm a partner in RSM Legal, and I specialise in private client legal work. Well, how terribly strange the first half of this year has been for all of us, really, let alone for trustees. We have faced a perfect storm, which may have brought many things to a head at the same time. I thought it might be interesting and hopefully in turn useful to touch on a number of issues which trustees might be facing or need to think about in the current climate, whether that be investment performance and beneficiary demand or the impact of flee clauses. Next slide, please. Taking investments and beneficiary demands first. Trustees, settlors and beneficiaries alike will have been concerned by investment volatility over the recent months. I mean, haven't we all? In addition, as the economy continues to struggle, beneficiaries of trusts have perhaps found themselves furloughed or made redundant, and they may be turning to the family trust for more financial support than they usually would. In the context of investment portfolios, the starting point is that if the trustees have complied with their duty of care in appointing their fund manager, they are unlikely to be liable for the investment manager's acts. As a result, investment performance should primarily be the investment manager's concern. Nonetheless, trustees should always keep that arrangement under review and, if appropriate, consider whether they need to make a change. If they haven't done so recently, now would be a really opportune time to review those contractual terms and the relationship with the investment manager. The trustees should also ensure that they maintain an active dialogue with the manager and check that the advisor is doing everything that they can to mitigate the losses to the portfolio. The trustees should also revisit the scope of their duties in this regard within the trust deed. Of course, some trustees hold trading companies and other entities as well as or instead of the traditional investment portfolio. Some of these companies may be feeling the strain and find themselves unable to issue dividends. Next slide, please. In turn, the performance of the trust fund may hamper the trustee's ability to make capital and/or income distribution to their beneficiaries. They might need to tighten their belt as a result of reductions in income or, worse still, capital. While this might not be the trustee's fault, as we all know, beneficiaries are not always the most understanding audience, so this could result in some unwarranted scrutiny of the trustees. With this in mind, the trustees may wish to review the trust deed's anti-Bartlett clause. The efficacy of these clauses has come under particular scrutiny in recent times as a result of the Hong Kong case related to DBS Bank, which has caused trustees around the world considerable concern. I don't propose to cover this case in any detail here. We have covered it in a recent Offshore Messenger article. Other than to say, fortunately, before the pandemic hit, the Court of Final Appeal in Hong Kong held that the anti-Bartlett clause in that case was valid and provided the trustees with protection. Of course, this doesn't mean trustees should be complacent. The facts of the case were extreme and rather unusual. It all comes back to the fact a well-drafted trust deed with a good anti-Bartlett clause is always important. Next slide. On a completely different topic, I wonder, do any of your trusts have a flee clause? Well, this might seem an unusual question, given that flee clauses are not as popular today as they once were. I imagine some of the old trusts within your book of business will include them. When I've seen these clauses included in offshore trusts, they are largely designed to be triggered in the event a local government falls, war breaks out, or a natural disaster. I don't think anyone could have envisaged a pandemic the likes of which we are living through and the impact that might have on a flee clause. Primary question is if any of the declarations issued by governments around the world triggered a flee clause in one of your trusts, and what does that mean? The governments which have declared national emergencies have been wide and varied, from the Bahamas to New Zealand and many countries in between. Once triggered, a flee clause is designed to automatically move the trusteeship and administration of the trust from its current location to another jurisdiction, often a jurisdiction which was seen at the time the trust was created as a safe haven. This is achieved by the current trustee automatically retiring in favour of another trustee, and often the replacement trustee is part of the same group, but based in a different jurisdiction. There is no opportunity for the trustee to consider and apply its mind to whether it is or is not appropriate for the clause to be triggered, what the tax implications are and associated costs, let alone whether it's in the interests of the trust's beneficiaries. Next slide, please. Furthermore, flee clauses were designed to address a problem in one jurisdiction, but COVID is having a global impact. It's very unlikely the flee clause was designed to cater for such a situation. It's easy to see how a trust might be moved from jurisdiction 1, which is declared a national state of emergency, to a second country, which is also declared a national state of emergency. What happens then? Hopefully, none of you have found yourself in this situation, or those of you who have, with legal advice, have found a way to address the issue. If you have trust with flee clauses but haven't given this any thought, you really should do so now. It seems to me that the pandemic presents a stark warning in relation to flee clauses, which have probably been long forgotten. It would be wise for trust companies to review their book of business with a view to identifying the trusts which include a flee clause, so they might seek legal advice and take appropriate action. This might include amending the clause to ensure the trustees have some discretion as to when such a clause might be triggered. Next slide, please. Moving on to a different topic, the residence of trustees, which was forefront in many people's minds in March when the pandemic hit and people were stranded all over the world, often far from home and unable to return due to the travel restrictions that were imposed. Some people may have found a positive in this situation, being stuck perhaps in the Caribbean with glorious sunshine. But no doubt, individual trustees of trusts felt very different. As we all know, the residence of a trust is primarily determined by the tax residence of its trustees, individuals or otherwise. If a trustee was one of those unfortunate to be stuck outside their home jurisdiction, potentially somewhere like the UK or the US, this presented a potential impact and changed to the trust's tax residence. While we clearly do not want to get bogged down in the details of the statutory residence test today, it is worth noting what amounts to an exceptional circumstance in the context of that test, and the significant concerns that we all had early on in the pandemic that it was less than clear whether COVID was an exceptional circumstance. Fortunately, although it felt like it took absolutely ages, the revenue did eventually confirm it was sympathetic to those stuck in the UK. That said, if you found yourself in that situation, it would be prudent to consider appointing an additional non-UK resident trustee to ensure that the majority of the trustees would be non-UK resident throughout the period, rather than being at the revenue's mercy. Clearly, the same is equally true for directors of companies who should consider whether their personal residence position during the pandemic might affect the corporate residence of the company. Next slide, please. But what of other important roles within the trust structure? In the current climate, we're all a little bit more cognizant of our own mortality, and all the things we've been meaning to do but haven't got quite round to doing yet. The same may be true in relation to some of the roles linked with your structures, whether that be settlors, directors, protectors. Now, what's going to happen if people in those roles pass away or become incapacitated? Planning for these eventualities is so important, but it is often not prioritised to the degree that it should be. If we start with settlors and their letters of wishes, no doubt you are in frequent contact with your settlors on a regular basis, and you ask them whether the latest letter of wishes that you hold continues to reflect their current wishes. In the circumstances that we're currently experiencing, even if you undertook this exercise recently, it would still seem worthwhile checking in with the settlor again. After all, there's nothing like a pandemic to focus the mind. You may also find that whilst they do want to make some changes to the letters of wishes, that if they didn't, they might want support, help and guidance in other regards, perhaps some additional estate and succession planning. Maybe they've finally decided to progress with that family governance and constitution document that they've been discussing with you for years. Another group to think about is the protectors. Do you have trust where the protector has the power to appoint their replacement on incapacity and/or death? And if so, have those protectors appointed their replacements? If they haven't, it really is time that they did so. And what of company directors? Have the company directors appointed alternate directors should they become unable to act for any reason? If not, the directors should consider making such appointments just in case, thereby enabling the board of the company to continue functioning should the worst happen. Next slide, please. And another thing to think about, do any of the trustees that you have beneficiaries or settlors that have a testamentary power of appointment to exercise? These powers are so easily overlooked by beneficiaries and settlors when they come to put new wills in place. If you have any trusts of this nature, it would be prudent to remind the beneficiaries and settlors in question not to overlook exercising the power in their wills. Of course, with all of these issues, you also need to ensure you're comfortable that the individuals in question have got mental capacity and are not under any undue influence at the time they perhaps update their letter of wishes, sign documents for you, or provide instructions to you. Exactly how a trustee might satisfy themselves of this at this moment in time is a bit of a conundrum. Hopefully the trustee already knows their settlor and beneficiary sufficiently well, in which case suggesting a virtual catch-up meeting in order to have a chat and ask some standard questions might provide some comfort while making a contemporaneous note of the call for the file, showing that you've considered the point and checked it. While we remain in some form of lockdown, as it seems we're likely to do for some time, there is only so far that trustees are going to be able to go, but such keeping in touch calls would provide an opportunity to hopefully spot issues and raise concerns. Next slide, please. Last but by no means least, we have all seen the headlines about the increase in cybercrime, fraud and attacks during lockdown and how careful we all need to be. It's clearly a sad state of affairs, but it's probably to be expected. I mean, we're all working from home now, and if you can't go out and about to run your criminal empire, you can clearly run it from home just like we're running our businesses from home. I imagine that all trust businesses' in-house security and compliance teams have been alive to this issue as it impacts the business itself, but also the trusts that are run by the business. Looking at this from the perspective of a trustee's fiduciary responsibilities, there is no doubt in the current climate that trustees need to be even more alive to the possibilities that their trusts might be targeted, remaining alert to suspicious activities, especially those that are out of the ordinary or digress from the pattern of requests you normally receive. You may have put additional checks and verifications in place for the time being. For example, double verification of 2 different types rather than a single layer. While your beneficiaries will invariably find this very annoying and very inconvenient, hopefully they will understand you are only acting in their best interest to protect the trust fund. Clearly, what I've just mentioned is far from a complete list of things trustees should be thinking about at the moment, but hopefully it has given you some food for thought in relation to your fiduciary duties and responsibilities, and the particularly proactive way in which they need to be tended to in the current circumstances. If anything I've touched on has struck a chord and you'd like to discuss it further, please do get in touch. We are here to help. I will now hand over to my colleague, Rachel.
Thank you, Sophie. And hello, everyone. It's a delight to be here talking to you today, but it's also from a personal perspective a real shame that we're unable to travel out to the islands to see you face to face. And I do hope that we will be able to travel out and see you in the not too distant future. So today I'm going to cover some corporation tax issues related to your non-resident landlord companies. And the reason that I've chosen this particular topic is because, I'm sure you'll all be aware, corporation tax is now in force for non-resident landlord companies. And of course, it's a tax that as private client people, we have little familiarity with. And so I thought it would be helpful just to go through some of the basics that you will be facing over the coming year when looking at corporation tax and how that's going to apply to the non-resident landlord companies that you administer. Next slide, please, Dan. So the first thing I'm going to look at is some practical aspects, and the main one being the registration. So all non-resident landlord companies have to be registered with HMRC for corporation tax purposes. For all of those companies that were registered under self-assessment for income tax, they should have been automatically registered by HMRC by now, because you should have received your company unique taxpayer reference, or UTR for short, and that should have been issued by 30th of June this year. For any new property businesses that have come into being from the 6th of April, then you should notify HMRC and register. Any clients that have made income tax payments on account in the past, of course, you just need to remind them that they don't need to do that anymore because we're not within the income tax scenario. Some of you might find that your corporate landlords will have income tax credits on their HMRC account, and in those cases, the credits will be repaid. What you need to do is claim them on your 2019-20 income tax return and provide the appropriate bank details in that return for those funds to be repaid to the company. Next slide, please. Let's now actually look at the corporation tax return itself. So it has to be filed online. There's no paper return possible, so it has to be done online. It comprises of a form, and that's known as the CT 600. It also requires accounts and computations to be submitted along with supporting documents. I just want to touch on what we mean by accounts, because I think when this first was mooted that we were going to move on to corporation tax, there was a lot of speculation about what format the accounts would need to be in. Under income tax, most of your non-resident landlords would have produced a basic set of accounts. And the good news is that that can still continue under the corporation tax regime. So you don't need to prepare a full set of accounts, audited or otherwise. However, one of the issues that we do have is that HMRC works with what's known as inline extensible business reporting language, that's IXBRL, and you might see references to this. You might see references to this in various documents. Now, UK companies produce accounts under UK GAAP, generally accepted accounting principles. As I mentioned, non-resident landlord companies will not be required to produce accounts under GAAP. However, what they will need to do is produce a profit which conforms to GAAP principles. Now, in reality, what that means is that if RSM are doing your corporate tax returns, we will take the accounts that you have prepared and we will adjust those accounts to prepare a detailed profit and loss, which is in accordance with UK GAAP and will be submitted along with the Form CT 600 to HMRC. Now, the point here about IXBRL is that it will, IXBRL is a tagging format. And what we mean by that, it is a software enabler which allows HMRC's computer to read the accounts and read the corporation tax return electronically. Clearly, your accounts won't need to be tagged, but the detailed P&L will need to be tagged. And we have specialist software in order to do this. So again, on the basis that we are dealing with this for you, that will be done automatically by us and is not something that you need to worry about. Next slide, please. Let's just look at when the accounts need to be filed at Companies House. Now, only non-resident companies with a UK branch or permanent establishment in the UK will actually have to file accounts at Companies House. So for the majority of the companies that you administer, I suspect that this is not going to be a requirement. If it is, then it has to be done 9 months after the financial year end. When you need to pay corporation tax is not actually straightforward, and I'm going to cover that in more detail in a later slide. And the tax return has to be filed within 12 months of the accounting period end. So again, quite straightforward. If you've got a 31 March year end, you have to file the tax return by the following 31 March. Next slide, please. The starting point for all of your non-resident landlords that come within corporation tax is that they will all be required to pay their tax 9 months and 1 day after the accounting period end. And this is the standard payment date that you'll see me referring to in a little while. Next slide, please. So in this slide here, we'll see our standard position on the left-hand side. And this is where you've got a company with profits of up to £1.5 million. So in this case, the standard payment dates apply, and that's 9 months and 1 day after the accounting period end. And there's a little example there. So if your accounting period ends on the 31st of March 2022, in the example, you pay your tax by 1st of January 2023. However, if your profits are above £1.5 million, you have to look and see if you fall within either the large or the very large categories. Large categories are those companies with profits between 1.5 million and 20 million. These companies have to pay their corporation tax by quarterly instalments. And the first instalment is due 6 months and 13 days after the first day of the accounting period. So it's an installment basis that happens in the current year. So for the accounting period ending 31 March 2022, so remembering it's the second year because the first year you're following the standard payment, the first instalment will be due on the 14th of October 2021. If you're a very large company, you've got profits over 20 million. And again, the quarterly instalment payments apply, but in this case, the first instalment is due 2 months and 13 days after the first day of the accounting period. So again, taking that company with an accounting period end of 31 March 2022, first instalment is due on the 14th of June 2021. Next slide, please. The story doesn't end there, I'm afraid, because there is this concept of associated companies which impact those thresholds of 1.5 million and 20 million. Companies are associated with each other if one is under the control of the other, or both are under the control of the same persons. So what happens is you count the number of associates for your non-resident landlord, add 1, and divide those thresholds by the resulting number. Next slide, please, Anne. So just on this slide, we're showing a very basic situation where you've got your trust, which has its non-resident landlord. It also has a separate investment company and a separate company which owns property elsewhere overseas. So our non-resident landlord has 2 associates, the investment company and the property company, and therefore the thresholds are divided by 3. So in other words, you hit the large payment date where you have profits between 500,000 and 6.67 million, and the very large payment date for profits over 6.67 million. Now, when we're counting associates, it doesn't matter that that those other companies might be non-trading companies or non-UK resident companies. They're all just included. So just a point to be aware that, of course, with some of the complex trust structures, they have numerous underlying companies, and therefore those thresholds could easily be reduced quite dramatically, and you might find yourself needing to pay under the quarterly payment regime, either for large or very large companies. Next slide, please. A quick point on the accounting period itself. A lot of companies have a 31 March year end. So for 2019-20, when they're still within income tax, all income due for the period 5 April 2020 will be included in the income tax return. Then in 2020-21, under the first year for corporation tax, the accounting period will start on the 6th of April 2020 and run to the 31st of March 2021. And then thereafter, it will just follow the accounting period end. So relatively straightforward. Next slide, please. It's worth just noting what happens in the case of income tax losses, because a number of companies may have losses brought forward from the income tax era. Now, those losses will be carried forward into the corporation tax regime as long as that rental business continued at 5 April 2020. And those losses can be offset against the future profits from that same UK property rental business, and for good measure against non-code loan relationship profits, which are broadly profits from lending activities. Just be aware that the losses cannot be offset against capital gains, which are subject to corporation tax, and also these income tax losses brought forward are going to take priority over any new losses arising under corporation tax. Next slide, please. So I've just illustrated this by way of a couple of basic examples. In example 1, we have an income tax loss of £1 million in 2019-20, and in 2021 our corporation tax profit is 1.5 million, and therefore we deduct full amount of the 1 million loss, or the income tax loss, leaving just £500,000 in the charged corporation tax. Example 2 is a little bit more complicated. We've still got our 1 million loss from the income tax 2019-20 year, but in 2021 we now have a corporation tax loss of 500,000. And in 21-22, our profit is 1.25 million. So in this case, our income tax loss of 1 million comes off in priority, and we use 250,000 of our corporation tax losses to reduce the amount in charge to corporation tax to nil, and 250,000 of the corporation tax loss carries forward. Next slide, please. I'm just going to mention that some of you may have businesses, rental businesses, with far larger income and potentially therefore far larger loss positions. Under corporation tax, where losses are in excess of £5 million, there is a restriction on the amount of the carried forward loss that can be deducted against future profits in a particular year. They are not lost entirely, they continue to carry forward, but it's just the amount is restricted for up to £5 million plus more for the following year when profits resume. It's also worth mentioning that for corporation tax purposes generally, trading losses can be carried back. However, a property business is not considered to be a trading business, and therefore any losses cannot be carried back to earlier periods. Lastly, on losses, let's have a quick look at capital losses, which arise from the sale of assets. And these losses must be quantified and claimed on the corporation tax return and can only be used against capital profits. Next slide, please. Thank you. And that's the end of the quick run through for the corporation tax aspects. As I said at the beginning, I'm expecting a lot of this to be new to many of you. So we are here to help, and please don't hesitate to contact me or your usual RSM contact if you do have questions on this subject. Thank you.
Thank you, Rachel. Hello, everybody. So we're going to finish off with the highlight of the talk, what everybody looks forward to, discussions of DAX 6. I'm conscious of time, so I will try to move quickly through some of my early slides, because what I really want to concentrate on here is some practical examples to give you a flavour of how these new rules are actually going to work in practice. So if I have the next slide, please. Just as a reminder, DAX 6 is a reporting obligation which applies wherever there is basically a cross-border transaction which involves the UK or an EU country. And just to confirm, the fact that the UK is leaving the EU doesn't make any difference. The UK is implementing DAX 6 in full. The reporting is based on hallmarks, which basically means if you meet definitions within the various hallmarks that are included, you have to report. And the important thing to remember here is that it doesn't really matter what your motive was in doing something. What matters is simply, do you meet the letter of legislation? Next slide, please. I don't want to spend a lot of time on the hallmarks because we will look at them in relation to the examples. But just as a very quick overview, the first three hallmarks involve two elements. You have to have a main benefit test, which means that you could reasonably expect to gain a tax advantage, and then you have a factual hallmark test to go along with that. And as the slide says here, the definition of tax advantage sits somewhere between other definitions. So tax advantage is a wider term than tax avoidance. I don't need to have been setting out to do something naughty to be caught by this. But on the other hand, not all tax savings are a tax advantage in terms of the legislation. So it's a bit of a tricky one to position. You need to be aware of that. Next slide, please. The final three hallmarks don't require there to be any tax benefit in order to apply. The good thing is most of these actually aren't going to be relevant to structures you're looking at because they're mainly sort of group corporate type things. But there are two key things that you need to be aware of, which are there is a hallmark relating to undermining reporting requirements, which could apply if assets get moved to a jurisdiction where CRS is not involved, and where we have non-transparent legal or beneficial ownership with unidentifiable owners, which is a bit of a mouthful, but basically means if you've got a structure which is opaque in terms of its ownership, let's say because you've moved a company to a country where there is no sharing of information about ultimate beneficial owners, that will be a hallmark. Next slide, please. This is all important for trustees and directors and intermediaries generally because that's where the obligation to report primarily sits rather than with the ultimate beneficial owners themselves. There's no de minimis, which means you can't just say, well, it was only a few £100 we moved. Everything has to be reported if it's caught. And as the slide says, penalties can be huge. I always use the example here of Poland because it's the really scary one. In Poland, the penalty for failure to report correctly on taxes can run into millions of euros. There's also a problem in that every country has interpreted DAC6 slightly differently. Poland, again, I'm told, has a massively long and complicated form that you have to fill in, and if you get it wrong, you're into penalties. The UK, by comparison, has a relatively light touch approach. And as well as making sure that you're putting in the right paperwork to the right country, everybody who is an advisor on an idea is potentially an intermediary. So you could have multiple people looking at filing. That's going to be a problem where you get lots of people putting in different types of filing. So you're going to want to make sure that you've got consistency, and you're going to want to make sure that you've centralized the process so you don't have three different people coming off and telling their authorities three slightly different things. Having centralized reporting and having oversight is also going to be really important for protecting you, because penalties will be mitigated if you can show you've got proper internal procedures in place. I'll come back to that at the end, but this is a really important point. You're going to need to make sure that you have procedures that you routinely apply when looking at all potential transactions and arrangements if you want to protect yourself when things go wrong. Next slide, please. I did just want to mention time limits for reporting because these have changed and in a good way. It remains the case that any arrangements that happen from 25th June 2018 will have to be reported, but originally they had to be reported by 31st August, and now that's been pushed back to 28th of February next year. Likewise, transactions or arrangements entered into from 1st of July 2020 were originally going to be reportable within 30 days, but now only have to be reported by 31st January next year. And that means that the 30-day reporting deadline now only applies to arrangements entered into from the 1st of January next year. So you've got more time to work out how to go about things. Next slide, please. So let's finish off by looking at some examples. And what I've done here is three examples that hopefully are sort of realistic, but which cover some of the practical issues we're going to have to think about. Let's start with the simplest type of thing I could really think about, something that I think everybody on this call will have had practical experience of. offshore trust, which owns an offshore company, which owns UK commercial property. One of the hallmarks under the first three main benefit test hallmarks involves the use of standardized documentation. And you could well argue that that's going to apply here because we're going to have standard documentation in terms of our company documentation. Our trust deed is probably pretty standardized, and the documentation in relation to the property purchase is also pretty standard. So we do need to think about Tax 6 reporting for this type of structure, which would obviously be a big pain in the backside if we had to report every one of these structures that's been created since June 2018. So is there a sort of a defense? Well, the main benefit test talks about obtaining a tax advantage that cannot reasonably be regarded as consistent with the principles on which the relevant provisions are based and the policy objective of those provisions. So what does that mean in English? Well, if you are doing something which creates a tax advantage, but that tax advantage is clearly consistent with the intention of the legislation, you won't have to report. So in my property scenario, these days, commercial property in the UK is subject to income tax on rent, capital gains tax on profits, whether it's held by an offshore company or not. So there's no tax advantage there. But it does remain outside the scope of IHT because the company that owns it will be excluded property. So that is a tax advantage, but we can be confident that it's a one that is within the policy objective, because when Parliament changed the rules governing residential property in IHT in 2017, it would have been the easiest thing in the world to include commercial property at the same time. In fact, if anything, it would have been easier just to cover all UK real estate than to carve out residential property in the way they did. So the fact they decided not to include commercial property makes it very clear that the IHT savings available on commercial property are deliberate, and therefore we're not going to meet that main benefit test. So the good news, you're not going to have to report all of these structures. Next slide, please. Next thing I wanted to look at is the impact of low tax jurisdictions. So my example here is that I have a Jersey trust settled by a UK resident non-dom individual. The Jersey trust owns a Luxembourg company, and we also have a UK company in the mix. The UK company makes annual IP rental payments to Luxco, and UK Co claims deductions for those payments. Luxco is taxed. Luxembourg does apply a tax rate on these IP payments, but it's pretty much zero. Now, our Luxembourg advisors are going to look at this structure and say there is no tax advantage because Luxco is paying tax at the prevailing Luxembourg rate. Excuse me. But from a UK point of view, the UK company is claiming a deduction which reduces its profits. Now, I would say for UK Co, arguably there's no advantage here because, or at least there's no advantage that goes against policy, because it would have got that deduction whoever had received the payment. So UK Co is kind of indifferent whether it pays to Luxembourg or to another UK entity. Our UK resident non-dom settlor normally would have Luxco's income attributed under the transfer of assets abroad rules unless the motive defence applied. If the motive defence does apply, then by definition there's no tax advantage being sought here and we're okay. If the TOAA rules are disapplied because, for example, of protected trust rules, I think we can also rely on that because that is a clear bit of legislation that is put in place in order to stop your UK DOM settlor getting a tax charge. So I'd be comfortable in this scenario that, again, we have no DAX 6 reporting. But what if we just change one fact in our situation? Next slide, please. So here, my settlor is UAE resident, not UK resident. And in that situation, there is no TOA attribution to our settlor. And here we've basically got an absolute tax saving. Because we're making this payment to Luxco rather than to a UK company, the IP payments leave the UK tax net permanently and are hardly taxed at all in Luxembourg. And that brings us within the hallmark C1, as the slide explains. My Luxembourg advisors are still going to say there's no reporting for them because they're paying tax at prevailing rates. But UK Jersey advisors are likely to have to report this arrangement. So be careful, just because one set of advisors tell you that there is no reporting required, that doesn't mean that what they can rely on, you can rely on. Next slide, please. A final example, non-compliant jurisdictions. So here I have my Jersey trust, which owns a Jersey company, which in turn owns a US LLC. Now, as we know, Jersey is CRS compliant, so anything going on within the trust or the Jersey company is also compliant for DAX 6 purposes. But the US is not CRS compliant. Although the US has FATCA, FATCA is not an equivalent to CRS. So by putting assets into our US LLC, we are potentially doing a transfer which is DAX 6 reportable, because we're taking it away from a CRS compliant jurisdiction into a non-compliant jurisdiction. There is no requirement for tax advantage here. So the fact that we were just doing this for purely commercial reasons is no defense. And the legislation talks about it being reasonable to conclude, by reference to all the facts, that the transfer is designed to circumvent or has the effect of circumventing CRS legislation. In other words, even if you weren't trying to avoid CRS, if you actually avoid CRS by making the transfer to a US company, you could still have to report. I think this is a really important point. It may well be that in the structure that I've described there could be reporting under CRS through our Jersey entities or the funds that we put into the US LLC. And if that's the case, we'll be all right. But you're going to have to look at all these cases where you've got, let's say, I don't know, a Panama company perhaps, or definitely US entities, where having those entities at least needs to be reviewed to see if you've got a DAX 6 reporting issue. So, lots of potential practical issues. You won't be surprised to learn that RSM are able to help you out on these. So, the next slide, please. I spoke earlier on about the need to have internal procedures in place. We're able to help with software to manage that process and to help you monitor on all of the various entities you've got, whether you need to think about DAX 6 and to record that logical thinking to show that you've done things properly. We can also help do an audit to make sure you're operating the procedures properly, as well as helping on those tricky individual cases where you're not sure whether you're caught or not. And if necessary, we can help you make individual disclosures if you need that. There is what I think is a really good resource on our website in relation to DAX 6. These slides will be circulated after this webinar is finished. So you can look at that link, and there's lots of information on there which is helpful, summaries of what the hallmarks are. discussions about how things are going to operate in practice. So hopefully that will be of some assistance too. And with that, let's go back to Gary.
Thank you, Andrew. Thanks for tackling the joys of DAC 6 in such a thorough way. And thanks to all of our speakers for that. As I say, there is a chat bar or Q&A bar on the right-hand side of your screen where you can ask questions. So if you do have any further questions, please raise them now. We'll just run over and can see it's already 12 o'clock. We are running just slightly over, but I'll deal with one or two questions, but please feel free to add some if someone sprung to mind now. Andrew, just starting with you, I just wondered, obviously we can help with lots of elements of DAC 6 and reviews. Do you think it will be helpful future when penalties come to see that perhaps an external review has been undertaken? It feels a bit like a level question. Perhaps a kind of a second follow-up question. What if it has been agreed between all parties, as you quite rightly said, that one party will report and then ultimately they don't report, but you are an intermediary?
That's a really good one, actually. So to the first part of that, yes, I think you need to be able to demonstrate that you have taken those procedures seriously, because it's not enough just to have a handbook of procedures, stick it on a shelf and nobody ever takes any notice of it. If penalties are going to be applied, you can mitigate them potentially to nil by showing that even though you missed it on this occasion, you were taking the right measures, and those right measures must include making sure, getting that audit approach, making sure somebody is looking at it to demonstrate that you are taking it seriously, you're doing your best to deal with this. And I think on the non-filing point, the short answer is you can't rely on anybody else doing it. So if you've agreed that one person will do the filing for everybody, which actually I think is a sensible approach, I think it's a good idea, you will still need to make sure that they circulate to you a copy of what they have filed. Because just relying on somebody saying, oh yeah, I'll do it, isn't taking proper measures. So yes, really good idea to get one person to do the filing for everybody. But if they're going to do that, they do need to circulate what they've filed so that you can see evidence that they have filed that with the authorities, rather than just crossing your fingers and hoping for the best.
Good, thank you, Andrew. Going all the way back to the start, a quick question for Sophie. Flee clause is not something which I've certainly come across. But a very, very interesting point nonetheless. And I suppose the question would be is if the country that you're supposed to flee to you can't go to, either because of lockdown or pandemic, or you need to leave that country that you're in because of some other reason, what happens if no other country is named as a free destination? I'm hoping Sophie is still there and not on mute.
Hang on. Hi, can you hear me, Gary?
I can now hear you. Thanks.
Okay. Sorry about that. Dodgy mute button.
Yeah.
It's a very good question, is what I was saying to myself. It will all depend on the flee clause in question. They were all drafted so very differently that it would be a case-by-case sort of exercise. They would need to be reviewed and, with some legal support, and the outcome of that conundrum identified. As you say, it could be that a national disaster has been declared in country A, it flees to country B, who's also declared a national disaster. What does the clause provide for? It may not do, and that will be a problem that would need to be addressed on a case-by-case basis.
Thanks, Sophie. It's certainly an interesting point around flee clauses, particularly at the moment, where it might not be so easy to flee somewhere. Thank you. And in the interest of fairness, a question for Rachel as well then. Rachel, just a quick question around the self-assessment tax returns, income tax returns that were done, for non-resident landlord companies. You said if there's a credit that should be repaid. Question one is, can we use that PT rather? And secondly, corporation tax is of course completely different system, so you need different tax reporting software for dealing with that. So two questions.
Yes. Okay, so just tackling the first one first on income tax credits on your account. My understanding is that these will actually be repaid. They're not going to be carried forward into the corporation tax regime. I'm afraid I don't know the reason for that. I suspect it's just because they are two separate taxes. And your second question was regarding different software. Yes, of course, it is entirely different software that we use internally for income tax reporting as opposed to corporation tax reporting. And I think the bigger issue that a lot of the offshore intermediaries will face actually is this tagging business, that the detailed profit and loss has to be tagged when it's submitted to HMRC, and again, specialist software is required for that, which, as you know, Gary, we are well able to provide for our offshore intermediary contacts. Thank you.
Good. Thank you, Rachel. I think on that, in the interest of time, we'll start to wrap up. I've got two very final slides, which I just want to mention to you and just share with you in closing. Of course, RSM is the 6th largest global accounting firm, so we are in many locations, 120 countries around the world. But what's slightly new is that we now have an established and working cross-border private client business, which was launched at the end of last year. So that allows us to work closely across our offices in continental regions, and then we have a global committee to ensure we all join up. This allows us to work with multinational families from their preferred location, but we can advise wherever their family members, whether they have wealth structures or investments in a joined up way with one core relationship lead. I think that's becoming increasingly important as families themselves become more multinational. But as a wider RSM business, we are globally focused on the middle market, often family-owned private businesses and all of their related wealth across all of our services. So our PCS services are much more than just legal and tax services, but broader accounting and consulting services all focused on the same client base, wherever the client is in the world. In the UK, of course, you've heard them today, we've got some great and fantastic deep technical specialists, but we're also about to launch a broad family and business advisory offering quite shortly. So if we are working with you already, thank you very, very much. Well, hopefully we can continue to do more business together in the future. If not, please make contact with me or any of the speakers, presenters today, and we can always discuss ways in which we can better connect. And very finally, on my last slide, we, of course, as a firm, as you would expect, produce a lot of very good focused collateral covering lots of different issues. If you're not already and you would like to be on our mailing list, please go to our website, the address there, rsmuk.com/preferences, and register. Or if you're already receiving them, please go and update your preferences. You can choose to have very targeted mailings in order to avoid inbox overload. So finally, a very, very big thank you to all of our speakers at this seminar, and thank you all for joining us today for this online offshore event. Thank you.